So you get your clients in a position of good comp, bad comp, and especially for the surviving spouse, you do it. So portability is a mirage. I don't even, it's for the case where there was no planning. Somebody dies intestate and they wind up not doing the right thing and using their exemption. Now this is this idea that Diana Mitchell and I came up with, the supercharged credit shelter trust. Here's how it works. Each spouse creates a lifetime Q-tip trust for the other. Now if I create a lifetime Q-tip trust for my wife, any gift tax? Nope, as long as I'm a U.S. citizen. And the trust that I create for, she creates for me, no gift tax. So I now have a lifetime Q-tip trust for my wife, and Diana has created a lifetime Q-tip trust for me. And Diana, tell us again, who is the grantor for grantor trust purposes of the lifetime Q-tip trust that you created for me? She is. And the lifetime Q-tip trust that I created for Diana, David, I am, okay? Even though it's for her, I'm the grantor, and even though she created for me, she's the grantor for federal income tax purposes. Now here's what happens. I die. That lifetime Q-tip trust uses its assets to create the credit shelter trust for Diana. Now it's included in my estate under what section of the code? 2044 says the lifetime Q-tip trust that Diana created for Jonathan is includable in his estate when he dies under section 2044. But what we're going to do is we're going to create the credit shelter trust for Diana. And by the way, Diana's descendants, not mine. But this lifetime Q-tip trust she's created for me is going to automatically morph when I die into a credit shelter trust for Diana and her descendants. Now, even though, and this is one of the keys, even though that trust has been included in my estate, Diana remains the grantor of that trust for income tax purposes. What happens when that trust earns income? Who gets that income, by the way? The trust gets it. Who gets the tax bill? Diana. That means that trust grows on a tax-free compounded basis. What is tax-free compounding? The most important thing in financial planning, of which estate planning is a subset. This is an extraordinary event, and I'm going to show you here in a minute. The bottom line is the following. You will wind up, again, depending upon the rate of earnings, what the income tax rate is, how long the surviving spouse survives, that trust, when Diana dies, that credit shelter trust created out of the Q-tip that she created initially for me, which is now for her and her kids on a discretionary basis, that's going to be somewhere between 2 and 10 times larger than if we hadn't make it a grantor trust with respect to Diana because of the power of tax-free compounding. Now there's something more. You've got to listen to me right now. When the surviving spouse for whom the credit shelter trust was created dies, are those assets included in her estate? Yes. Let me ask the question again. That credit shelter trust that I created for my wife, when she dies, are those assets includable in her estate? No. No. And in fact, that's the reason for doing the credit shelter trust, because it's not going to be in her estate. Is there going to be a tax-free step-up in basis on those assets? Not going to be includable in her estate. Yes. Anybody got another answer? The answer is no, probably, although Mitch Gans and I have a theory that there would be. But the bottom line is no. There's a trust for your benefit. It's not in your estate. You don't get a step-up in basis. Remember my client who got sick and we borrowed the $18 million? Well, what happens when Diana is old and gray, and now that trust might be worth, may started at 5, it's now worth $22 million, a lot of appreciated property. Her son Christian is going to take the power of attorney, go to the bank, borrow the $22 million, and buy the assets back. By the way, is that purchase subject to income tax? He's having Diana buy the assets back. She's the grantor, the assets back from the trust for cash. And the IRS is there with a camcorder, watching the whole thing go down. They know the basis is $3 million and she's paying $22 in cash. Why? Oh, 8513. If you don't know 8513, Well, not only do you have to know it, here's the deal. The community foundation here, I can't believe Colleen left, but Bill will give them to you as you leave. When you leave today, Bill's going to hand everybody a white gerbil. And what you're going to do with that white gerbil is you're going to take it to one of the fine tattoo parlors here in Naples. And there were a lot of nice ones, Bill told me. And you're going to have the tattoo artist put on the back of that white gerbil, 85-13. So every night when you come home, Laird, and you pet your gerbil, you're going to see 85-13. By the way, I want to suggest something else. You actually should read the rule. I know that's heresy almost, but you ought to read the rule. By the way, what's going to happen when the gerbil dies? You're going to take it to one of the fine taxidermists here in town and have the high tan and put it on your wall, and forever you'll see 85-13. It is the most critical thing of all. So not only does it mean that the trust is going to grow on a tax-free compounded basis, it means you can get the equivalent of a tax-free step-up in basis at the time that the surviving spouse dies. It is of extraordinary dimension. Now, suppose you're in a second marriage situation. I've posited that Diana and I are in second marriage situations, and maybe you're going to have some resistance about having your spouse create this trust for you and you create the trust for her. But here's what Diana came up with, which is a great idea. You're going to allow them to remain revocable until you know who's going to die first. So Diana and I create these trusts now, and 7 years down the line, I get a terminal cancer or a condition we know I'm going to die first. She makes mine irrevocable, the one she's created for me, so it's going to be in my estate, and I'm not going to make hers revocable. And let me tell you why that's such a good deal. One of the real challenges we face with our clients today is that they don't have enough money to use their full estate tax exemption. I mean, most people I know, the couple doesn't have $10 million. You know, maybe they have 3, maybe they have 6, but very few couples that I know have $10 million. What would be ideal is if we had 100% of the assets includable in the estate of the first spouse to die, because that way we stand a better chance of getting the ability to use the full exemption. So suppose Diana had put $3 million in trust for me, and I put in $3 million for trust for her. We find out I'm going to die first. Diana makes the credit shelter, the lifetime Q-tip trust for me, irrevocable, which is going to morph into a $3 million credit shelter trust for her and her descendants when I die a few months down the line. But what I'm going to do is I'm going to keep mine revocable. So not only is the lifetime Q-tip trust that Diana created for me going to be in my estate under Section 2044, the lifetime Q-tip trust I created for her is going to be includable in my estate under what sections of the code? It's a revocable trust. 2036A1 and 2038. So now 100% of our marital assets are going to be included in the estate of the first spouse to die. So when you're talking to that couple, and it doesn't matter again whether it's a first marriage or it's a second marriage, whatever it is, you're going to say, we're going to structure this as long as you will call us, and when you know who's likely to die first, we hope that never happens, but when it does happen, and you've got older taxpayers here so you can be pretty sure it will, give us a call and we'll make that one irrevocable, we'll keep the other one revocable, and that means it's all going to be in the estate of the first spouse to die. One is you may get a step up in basis on all the assets when the first spouse dies. No guarantee on that because of Section 1014E, but that's it. Now, to me, again, the Supercharged Credit Shelter Trust, this appeared in, when did it appear, 2008, Diana? I don't know. But by the way, that little article by my brother and me, it's cited to that article. You really ought to use it. But by the way, let me tell you something. This took Diana and Mitchell and me about a year to figure out all the kinks in it, and I've only given you part of the story. I've kind of given you the end result. You're really going to have to put in some time and effort. You ought to have a special, luncheon at Ackerman to go ahead and go through it and make sure everybody understands it. I'll be happy to come. In fact, are you WTP subscribers? You're going to be? Yeah, well, the form is right there with an explanation of it. You push 2 buttons and you've got it there. But this is something, again, it's great for your clients, but it's also great for your practice because you get to do 2 additional trusts for every married couple, for which they should be happy to pay you, because it means millions of dollars more for their descendants, but they retain the benefits of it for the rest of their lives. But again, it did take us a long time to figure that all out. Now, let me go on and let's take our next topic, which is Alaska community property. Now, I practiced out in California for a number of years, and I didn't know much about community property, but it's a fairly simple system. And the states of Louisiana, Texas, New Mexico, Arizona, California, Nevada, Washington State, Idaho, and by statute, Wisconsin have it. And it is the most rational type of property ownership, I think, between a husband and wife. It was put in throughout all of mainland Europe, not England because he couldn't conquer it, by Napoleon Bonaparte. It basically says anything that the husband or wife earns during the marriage belongs 50-50 from inception by either of them. And by the way, before the marital deduction, this provided a huge advantage for people living in community property states. So a man dies in California with an estate of $2 million. Only $1 million was includable in his estate. Why? Because the other $1 million, from the time it was earned, belonged to his wife. It's a very rational system because whether you die first, you die second, whether you get divorced or whatever, it's always 50-50. You have a crazy system here in Florida. We have a crazy system in New York. Here's how it works. Diana and I get married. Let's assume there's no prenup, and Diana divorces me. What is she going to get? She's going to get essentially 50% of the assets acquired during marriage, and that's essentially what happens under a community property system. But suppose Diana and I don't get divorced and we stay happily married and I die. What does she get under Florida law? A third. So Diana's better off divorcing me. Isn't that crazy? You're better off. She goes to see her own lawyer and she says, well, I've got my kids and descendants and Jonathan has his. What should I do? He's got a lot of money. Divorce the SOB. Although the pool against which her third applies is everything I own, even if I brought it to the marriage, but the 50% in divorce is only things I acquired during the marriage. Crazy. Now, suppose Diana dies first. How much do her heirs inherit of my property? 0. Even if those assets were acquired during the marriage. Even if we got divorced, it would be. It's a crazy system. It's a crazy system. Community property, it's always 50-50 with respect to everything acquired during the marriage. Now, of course, whether you're in a community property jurisdiction or you're in another jurisdiction, you can go ahead and you can change it any way you want. You can have a prenup or a postnup, and as a general rule, you can change the property regime between the husband and wife any way you want. When the marital deduction came in 1948, it came in because almost every state in the Union had passed or was in the process of passing, including Florida, a community property regime. Because it said only half of the assets of the first spouse to die would be taxed, and more important, only half of the income that he earned would be subject to tax on his return. There was no joint return. So if you had a doctor in California who made $100,000, it was taxed as 2 sets of income as $50,000. But if he lived in New York or Florida or Massachusetts or Maine or Oklahoma or Oregon, it was $100,000. And because tax brackets were progressive, that guy in Oregon and New York paid much more tax. So all the states were passing. I mean, Pennsylvania passed a Community Property Act. It was about to pass in Florida. It was about to pass in New York when finally Congress said, look, rather than make all the states change their fundamental laws, let's adopt the concept of a marital deduction for half of the wealth, and let's adopt the concept of a joint return for married people, and that's how we got it.